this year we closed about 120 million. Last year we closed probably around the same, maybe 150, somewhere between 100 and 150. That's our bogey annually, which is about a 10% growth rate. We are still a pure play SNF healthcare REIT, which is about 93% of our portfolio is nursing homes. And so we continue to look at deals in that space. We really are big believers in the master lease structure. So we look for things that are a big enough portfolio in a new state or something that we could add to our current master leases.
So you recently noted that 2025 has been the strongest year for the company to date. What are some of the factors that have made this year so successful?
Oh, well, it's just because our balance sheet has grown, and we've consistently grown year in, year out. So this year we have the best results because we have the largest size balance sheet that's earning, where I think altogether our return is probably closer to about a 17% return between the AFFO growth and our dividend payout. We're something like that, about 17% return. It's a good year for us.
Any other factors helping?
No, it's peaceful. Our business is running real clean. We don't have any wonky things. We never really did. Our balance sheet has just rental income and interest income. We don't have any other shop. We don't have any other odd items that make the financials better or weaker. And so, just the bigger we get, the better the returns are. And that's just clean.
And Strawberry Fields has been active on the acquisition front this year. What types of assets are you most focused on? And do you expect this year's pace of activity to be matched in 2026?
So this year we closed about 120 million. Last year we closed probably around the same, maybe 150, somewhere between 100 and 150. That's our bogey annually, which is about a 10% growth rate. We are still a pure play SNF healthcare REIT, which is about 93% of our portfolio is nursing homes. And so we continue to look at deals in that space. We really are big believers in the master lease structure. So we look for things that are a big enough portfolio in a new state or something that we could add to our current master leases. But business is the same. We're just business as usual and, looking at a couple of hundred deals, maybe 300 deals a year and putting offers in maybe for 10% of that and then closing maybe 20% of what we put offers out there for.
And any geographic markets that are more important to you?
No, not particularly. I mean, we're buying off of where the Medicaid program in the state, where the better or worse. So we avoid certain states where, actually the biggest thing for us is since we're publicly traded, certain states have disclosure requirements on who the owners are. And when you have 7,000 shareholders and growing, it's hard to give a disclosure every day of the week to the state. So certain states can't be owned by us. Outside of that, we're really indifferent because we underwrite each purchase almost as if it was loan committee at a bank. Who the tenants are is a testament to, they have to have a good pedigree and learning the business and having the proper integrity and, be good people that we like and we want to stand behind and be proud of. And so, yeah, we'll go anywhere that they want to go as long as it's sizable enough for us to do the deal and it's sizable enough that we feel comfortable that if, God forbid, anything ever happened and we had to go in there and operate and stabilize it to pass it along to the next tenant, that it makes sense for us to do that. I mean, that's what sets us apart to a lot of our peers is that we're operator background to start with. And so we look at each deal as if I was going to be the tenant, not me playing landlord here.
And what do you expect to be prioritizing in 2026?
It's really on the stock side, not what we do. Business as usual, same investor matrix, how we buy things, same criteria on what we buy and who we buy for and who we lease to. But on the corporate side of things, what we're looking to do is, and we've talked about it on some of the earnings calls, we want to be more similar to our peers. So we're looking for an unsecured line of credit so we could replace part of the bonds and the conventional debt that we have out there so that when investors coming along to invest in our REIT, they can compare us to a different REIT and they could say, okay, all the boxes are similar now. Do we like the management team here and we like what they're doing? Do we like the industry? And then we can attract people based on, our industry, which is, nursing homes, silver tsunami, what's planned for, what's going on in America and, the baby boomers, right? We expect that business should be, our tenants should be able to keep their occupancy high, and And that's good for us because, the more money they make, the better our income stream is, the more, reliable we have that we could then dividend it out to the shareholders and use it to buy more assets.